All right, welcome back to this week's trading live stream. I wish it came on better circumstances, but what are you going to do? We always want to give an accurate outlook on the market, and right now that outlook isn't that great. We had the indexes roll over, a couple of leading stocks that broke into new 52-week highs either late last week or early this week, also reverse lower. The energy sector as a whole is starting to roll over. Looks like it was in kind of a double top. We had a megaphone pattern that we'll get to in a little bit that ended up breaking to the downside. And new highs or new lows minus the number of new highs is now expanding. So we're getting more new lows than new highs, which is unfortunate because just a week ago or less than a week ago, we had turned that in our favor for the bulls. And there's a couple things you could do. You can try and fight the market and disagree with it, but the market is always right. So we want to learn how to interpret all of those different factors into our own trading, how to scale out of the market on positions that we were in, on winning trades, and then also how to rotate into short positions. So we'll cover a little bit of that and how I handled Monday's action and today's action. We'll go over the indexes, look at the 12 potential market leaders that I cover on Twitter every day. We'll deep dive into each of those charts. And then just a couple of watch list names, both on the long and short side for me. But really what I want to do is make this as interactive as possible since the market doesn't seem like it's going to be very favorable for swing trading, at least to the long side, for the next at least couple days. So let's really use this live stream to go over any trading questions that you have, position sizing, entry tactics, anything like that. Drop it in the comments, or if you want to look at any charts, you could do so as well by dropping it in the comments. This live stream is sponsored by MarketSmith, which is that trading research platform that we're going to be using to break down each of the ETFs, all the setups, and the potential market leaders. If you guys enjoy the platform, want to give it a try yourselves, there's a link in the description below. Otherwise, just go to MarketSmith and try it out. All right, so first things first, want to take a look at the indexes. We'll widen it out a little bit. All right, so QQQ last week, Federal Reserve came out, had a little speech, said that they could be raising interest rates by less aggressive measures in as early as December. Market loved that. QQQ is up 4.6%, closed right near the high of the day. Had a little bit of churning action, no further move the next day on December 1st. And then from that point, we did gap down on Friday, right at the 8-day EMA, and buying support came in. So even through Friday, we were seeing positive action. The gap down obviously wasn't ideal, but it was a good way to test bulls because there was two different things that we were looking for, right? We were looking for continuation the next day after the Fed meeting, or a gap down that got supported. And we got that action. So ending the week on Friday, only down 0.4% after a 4.6% move on, was that Wednesday? Market was looking constructive. We were seeing the number of stocks break out into new highs, constructive. New highs were outpacing new lows for the first time in a very long time with the NASDAQ. And overall, the market was acting constructive on Friday. And then on Monday, unfortunately, we got a minor gap down to start and close near the low of the day. 0 out of 12 of the potential market leaders that we'll cover in a second were up on the day. That was a huge red flag. A couple of those leaders actually broke down under their 20-day moving average, another red flag for the market. And at TraderLion, we lost the bull to pivot. That's another market signal to either go to cash or get short. So at that point, I did take off all of my long positions and then started getting into some short positions that we'll cover in a second here. But week close on Monday, we closed on Monday down 1.7%, and then today we opened right on that 8-day EMA, sold off, bounced at 280, but closed under the 21 EMA. And I think we did so on an above average volume or above volume than the previous day. So it does count as a distribution day for the NASDAQ. We're looking at QQQ, which isn't exactly the same, but distribution day for the NASDAQ, not ideal. And obviously a risk off market environment now. SPY was holding up better than QQQ because it was more energy focused, less tech focused, and a lot of those tech stocks were the weakest stocks in the market. That changed when we had XLE, the energy ETF. I had drawn this megaphone pattern a couple times on Twitter, but basically when you get expanding volatility and you're a low risk trader looking for very tight price action, very tight volume action, so you can get a very tight stop loss and have asymmetrical risk reward in your favor, a megaphone pattern, as Mark Minervini calls it, is the opposite of what you're looking for before you enter a trade. You want to see price tighten up, volatility tighten up, and volume also tighten up. And that's not what we were seeing in XLE, the energy ETF. And eventually that megaphone pattern, more likely than not, it does conclude to the downside. Now, it doesn't have to always do that. There's no absolutes in trading, only probabilities and risk management. And the probabilities played out against the bulls at this point. Broke the megaphone down. Pretty large action yesterday, down nearly 3%, and then down 2.6%, undercutting that 50-day moving average and closing under it today. So when S&P 500 was outperforming the NASDAQ, it was partially because energy was so strong. And now that energy is also rolling over along with tech, there's really no place to hide your money on the long side. So we had a couple days closing over that 200-day moving average, sideways action the day after the Fed spoke, or Powell spoke. Gap down, got supported, closed right, only down 0.1% on Friday. Very constructive action, but we need to be, we can have a bias in the market, right? We can have a plan. Otherwise, we would never place a trade if we never had a bias, if we never thought a stock was going to go up versus going down. And that's fine to have, as long as that bias isn't blocking your ability to let information come in from the market and get that market feedback. So when we lost the 200-day moving average on S&P 500 or SPY, that's a red flag. When the leaders aren't acting the way that they're supposed to, that's a red flag. And look at your own trading. Are you gaining? We broke over the 200-day moving average on a day that was up 3% for the S&P 500. Were you making large amounts of money in a short amount of time? The number of stocks that were actually breaking out of consolidated areas, at least the stocks that I were watching, not too many there. I felt like I was missing out, but because I just missed the 3 to 5 names that were actually working well. So when those names started to break down as well, we just need to get that market feedback. And for one, always honor your stops. If you get stopped out on the way down, you're out. We want to limit that downside risk, especially we're still in a bear market, obviously now, but even like if we were trading sideways for a while over the 200-day, I would still say that we're in a cautious bear market until we start seeing breakouts like end phase, like breakout, push out, and not check back the way that it did today. We just have to be more cautious at this point. So here we're over the 200-day, but we're getting that market feedback, and that market feedback is saying it's time to take a break, take your profits, maybe go short if you're a more active trader. The growth ETF IWO, this is one that I like to review because it most correlates with my trading. Did get over that 200-day, actually was positive on Friday, up 0.7%, all things looking good. Then on Monday, we split the 8, the 21, and the 200-day. Today, we open under all of those and then close just above the 200-day moving average. Not a great look. Yeti Shark just pointed out something that I totally forgot to note, but financials started to break down today too, and that was a heavy hit for the S&P 500. So Yeti, thanks for bringing that up. And hello, Stacy and Kit. I appreciate you guys tuning in. RK, this is something that I've been keeping track of just to see what type of growth stocks are working in the market when we do get a market rally. Is it the stocks in stage 4 declines, which the ARK ETF is kind of a basket of stocks in stage 4 declines? And is it just that oversold bounce that we're seeing, or is it more constructive action across a larger group? And when we did lose the bull to pivot, when the S&P 500 broke under 4,000 yesterday, I opened up a 20% short position on ARK. That closed, I think I was only at like a 1% profit at the close yesterday, maybe a 1.5%. And then today, when it was down another 3.5, I closed out half of that short position. My stop's at break even now. So it's going to be a winning trade. That's really how I found the most success with shorting, is like putting the shorts on as the market's starting to roll over in larger ETFs, and then scaling out some profit as we get extended to the downside. So ARKK was one of my shorts. I did also, in my retirement accounts, I went long SQQQ with a break under the 4,000 area for S&P 500 and closed out half of that as well. And then AMZD, which is Amazon. In my margin account, I shorted Amazon yesterday. I put this on Twitter as well, but we'll cover this super quick before we get to the market leaders. Twice this came up to, I should even draw it more to the left, but not a perfect drawing. You guys get the point. We come up to prior support, now turned resistance because we closed over it once, twice, rejected on both of those. And then just a uptrend line now that we're shorting to look when you break under it. So right as we broke under the downtrend line or uptrend line, I started a 20% short position in my margin account on Amazon. For my retirement accounts, I went AMZD. This is just bearish Amazon, not a leveraged, just bearish Amazon. So a way to get some short exposure in an individual name in a retirement account without options. Options are a little complex for me. I try to stay away from those. Not poo-pooing on options. People trade them. People do very well. I just think that there's a lot of moving parts there, and I can control the risk a little bit better by using just the inverse stock. So those are a look at the ETFs and kind of how I handled the market on Monday and Tuesday. So Monday, I closed out my longs, went short about 60% of my account. 20%, 20%, 20% shorting ARK, Amazon, and TQQQ, or I went long SQQQ. And then I've closed out half of those positions, maybe a little bit more than half, throughout the day today. So now, unless we get a random like 3% gap up tomorrow, those will all be winning trades. I will have scaled out some profits on the way, which is all you can ask for, right? We don't know if the market's going to keep crashing down. We don't know if it's going to have a bounce back day, something like that, or actually start to trend higher. And maybe this was just a shakeout. It's a pretty strong shakeout, but maybe it was just a shakeout before starting to rally again. We don't know, right? We don't get paid as traders to predict. We get paid to react. And when I was seeing, I was extremely bullish on Friday, very, very bullish, but you have to allow yourself to let the market tell you what's going on and get those market feedback signals. And once you start getting signals that start to work against what your strategy was or what your idea was, you should be flexible enough, especially in this bear market where we've seen how many times do you have to stay flexible around these turning points to nail down profits and then flip the other way. If you're not a flexible person, bear markets are probably just something that you want to avoid altogether. But now taking a look at some of the leaders, another great sign is how do leading stocks react in the market. If they're holding up very well and the indexes are breaking down, that's a positive divergence that we want to see, but we don't want to see that divergence occur for too long. We don't want the leaders to go a week straight going up and then the indexes go a week straight going down, because we know a majority of the money are in the indexes. So when people are down a lot of money on their indexes, they're going to eventually sell their winning trades, to pay for their losses. And Enphase and First Solar a couple of weeks ago in October was a perfect example of this. They were holding up super well, and eventually that divergence became too strong and you had really sharp breakdowns under the 50-day moving average on both of them. So this type of action is what we want to avoid if we're in leading stocks and that divergence becomes just too large. We have to think in probabilities. So in a bear market, we want to always take note of stocks showing relative strength, but we don't want to act on that relative strength until the day that we're putting exposure on in the market is one that market breadth is expanding in our favor. I've been hurt by this many times in the first part of 2022, where I was noting a bunch of stocks that were holding up really well on a day where the market was getting clobbered. And I'm like, okay, these are the leaders. I'm going to make money. I can put some like tighter stops. Let's go. And eventually they keep all breaking down, because if market breadth is so bad and deteriorating. You're seeing your watch list go from 50-50 red-green to 70-30 red-green to 80-20 red-green. Chances are, thinking in probabilities, you're going to get stopped out of that position. So one thing that's been a big takeaway of mine in this bear market is we want to note relative strength on red days like we had today, but we want to act on that relative strength as market breadth is improving on that day. Because in a singles and double market where we're only getting 5%, maybe 10% on our average winners, 10%, if you're absolutely crushing it, go ahead, throw that in the comments if you're getting 10% on your average winners. I know I'm not. I'm getting about, I want to say like 6% at this point, maybe even a little lower after the shakeout on Monday. But in a singles and doubles environment, we want to always be putting on exposure right as the stock's moving in our favor. So we can do everything in our power to reduce the downside risk by either taking partial profits on that day or moving partial of our stop loss up to break even. Just doing anything we can to reduce that downside risk because we're in a very tough market environment, a market environment that we're looking for singles and doubles in. AEHR, this is one that everyone was watching, very deep bull. I think this was like an 83% drawdown from 27 to 671. Someone can check my math, but ideally you want stocks with a much shallower base than that. We do eventually take out the all-time highs on the 1st of December. I'm not buying any stocks breaking into 52-week highs. That is consistently been a trap in 2021, not something that I want, or 2022, not something I want to be involved in. I want to see some evidence of stocks breaking out into 52-week highs and getting follow through volume the next day, continuing to push out, and then having orderly checkbacks. Until, I keep posting this on Twitter, until I am sick to my stomach because I took profits too early multiple times, I get multiple data points about that, I'm going to be very cautious with stocks breaking out into like more traditional breakout areas, 52-week highs, or if you see something just set up just perfectly and there's just a very flat line across the top that you can draw, I'm a little bit more cautious with those. So I liked the action on the first. It was still up 4% by the time it closed, but it closed kind of in the middle part of the daily range, 52% there. Nothing terrible the next day. Held 25 on yesterday with kind of pulled back. It was down 4.1%. So that's obviously not ideal, but it still held the round number 25. Today just cut right through 25, cut through the 8-day and the 21 EMA, down 11.5%. When you're in a thinner traded stock, which I guess this is getting up there at this point, but heavily known by swing traders and not too many stocks also meet that criteria. Swing traders are all low risk traders, right? We use tighter stop losses. As the market rolls over, we want to go to cash as quickly as we can to reduce our downside risk. When you get stocks like this that are super crowded with that type of group, you can expect pretty drastic moves to the downside. So 11.5 on the way down. Hopefully your stop was hit as it broke through 25. If you were in the trade. But we'll see how this sets up. This chart's not like broken. It can still build out, but it needs to build out a true base, kind of like what it did here. And even that was a little choppy to trade. I never got in it. It's AEHR. Celsius actually holding up very well. Did make new highs on Friday last week. Yeah, Friday last week. Inside candle yesterday. Lower highs, lower lows today, but closed up 0.5%. Still above the 8-day EMA, not doing anything wrong. If it can build out another handle around here, that would be ideal for a lower risk entry point. But Celsius, one of the leaders that haven't seen the types of selling that many of the others have yet. DGII, this one's under the 21 EMA at this point, but not crazy volume on the way down, everything below average. Closing range today was right at 50% of the daily range, which is nice. Chart's not broken by any means, but it is more wide and loose than I would like for a low risk entry point. So not terrible in a strong group. Computer networking, 4th out of 197. Has the fundamentals, all that good stuff. Just needs a little bit of time, I think. Enphase, this is one that I wanted to cover a little bit more. So everyone can see this line, right? everyone in the comments. 325, pretty flat top pivot, breaking into all-time highs. I did like how this gapped down and opened below the previous day's low. So if I were to trade Celsius, and my most successful trades this year have been on oops reversals where you gap down below the previous day's low and then you immediately start to rally, and your entry point is when you take out the previous day's low. Typically you want that either around a round number or around the 21 EMA. At least for me, that's the couple times that I've had like very successful trades on oops reversals have been around round numbers or the 21 EMA. But this did gap down below the previous day's low, took it out, and then made a new high. So your lower risk entry point would have been on that oops reversal around 313. What was the low here? 312.50. So right around 313. I didn't take the trade. I also didn't take the trade when it broke into new highs. I'm not taking any all-time high breaks. I want to be monitoring stocks that make 52-week highs, but I don't want to be involved in the first break to the upside. It actually closed very well, and I was like, okay, maybe this is a character change for the market and for this stock. That would be awesome, right? We're all rooting, I'm skeptical that this stock is going to hold its clean break to the upside, but I'm rooting for it because if it does and we start to see character change and breakout trades start to work, that's awesome for us. That's how we can make a lot of money with a low amount of risk. Good action yesterday, closed basically flat, and then today just reversed lower. So yesterday we started to see a couple signs with all of the leaders down. 0 out of 12 were up on the day, and then today was kind of the bloodshed day where this broke through the 8, 21, the low from the breakout day, and closed right on the 21 EMA. Chart's not completely broken by any means, but needs some time. First Solar, similar action through the 8, through the 21, through 160 today. I was feeling foolish because I got stopped out at like 165. 165.50, something like that. And then we immediately make new highs, trade sideways, and then with end phase moving up, I thought I was going to be like really missing out, but now I'm not. It's down to 157, could set up again. EXTR holding up pretty well, still above that 21 EMA, pulling back on declining volume. It would have been nice to be higher in that range, but still not doing anything terrible. GFS, this is one that has been tough if you're trading it. It's a semiconductor stock. Continues to hold 60, which is positive at this point because it had a day where it came down right towards 60 while the market was much higher. Even on Friday, it kind of pulled back to 60 while the market was much higher. And we're still seeing support for the $60 area. I would want to see that obviously continue to hold and then buy on strength as we come out of there. It's GFS. HLIT, this was one of the leaders that broke down yesterday. So we had Enphase and AEHR breaking down today. Yesterday was HLIT breaking through the 8, the 21, the 50-day moving average, closing below all of those on above average volume, down 10.65%. And then today kind of just bounced back 1%. Not the type of action that you want to see. ON Semiconductor, another one of those like stocks that's super frustrating to trade. I haven't traded it in, I forget the last time I traded it. It's been a while, maybe May. I haven't had much success trading this. I don't know. Its personality doesn't fit very well with low risk swing trading, but it has the fundamentals. It has the relative strength. The characteristics of the price changes are a little tough. PI, this is one that I was really upset that I missed on the 22nd because I've been watching it. Had that 2 shakeouts to the 21 EMA, low volume day, the day before it broke out, and just sitting on the 8-day EMA. And we opened right there and then got out. I was just on a different stock when it went, and then I didn't want to chase. And this was up 6.5%, then 1.7, doing all well, up another like 3.4. It's getting super upset, but eventually it did kind of break to the downside, shook out to that breakout point, closed under the 21 EMA and the HVC, the high volume close level, around 115.30. So now this is having a little bit of trouble as well. RYTM had a little gap up and go, not doing anything wrong, above a rising 8-day EMA. That's a biotech stock. And then SMCI did undercut the 21 EMA yesterday, pulled back again, made a new low for the pullback at 81.03, but then reversed, recaptured the 21 EMA, recaptured the previous day's low, and then closed right near the high of the day, up 3.5%. This is probably the leading stock along with, Along with DGII DGII and Celsius that I'm really starting to track a little bit. All right, so those are the look at the leaders. I do want to go through my watch list, but I want to give you guys some time. So let me read some of these comments very quickly. We got people from Malaysia, Spain, Thailand. This is awesome. Isn't RK too beaten down to go much lower? It depends what much lower is. Any stock can go down 100%, right? They're not going to go down 100%, but I always want to be shorting the weakest stocks, the weakest ETFs in the market, especially because they weren't extended to the downside. If it's already extended to the downside, like on the day that it made its like previous lows here, well below the 8-day EMA, well below the 20, the 50, well, I don't want to start a short position at this point because it's so far extended. Just like we don't want to be buying a stock that's extended to the upside of all the key moving averages, we don't want to short to the downside a stock or an ETF that's already extended as well. Leif Sereda calls it shorting in the hole. We don't want to do that. But this, I shorted right through the 50, the 21, the 8-day EMA. The stock wasn't extended at all. It was just exhibiting, or the ETF wasn't extended at all. It was exhibiting a relative weakness instead of relative strength compared to the S&P 500. Nowhere near the 200-day moving average. Didn't make new highs compared to the previous time. So this was kind of like a bread and butter short setup. And it's a little bit, because it's an ETF, it doesn't have the like the possibility of getting acquired where it goes up 100% overnight, anything like that. So when I do short, I try to short more liquid stocks, Tesla, Amazon, SQQQ, ARKK. If you want in your retirement account, I was just going along SARK, that's the inverse ARK. But yeah, what's cheap can get cheaper. What's expensive tends to get more expensive. That's the great paradox of the market. And we don't want to be chasing in either direction, but we want to be noting like what's weaker, we want to short that. What's stronger, we want to go long that when the market breadth is starting to trend in that direction. Good question. Okay, Bob, let's see. Closed out all of your SQQQ. I should have only taken a third, but the market sold off so hard and fast. I'm with you. Most of my successful trades this year have been trades where like I felt bad about taking profits like on partial or on like a majority of it, and it goes a little bit further and then just reverses. So I think like the indexes have sold off pretty aggressively over the last 3 days. There's probably a little bit more juice to the downside, a little bit before a bounce back, but I think it's completely fine to take your profits while it's there, wait for a check back, and then short the roll on the downside as well. So who knows? One of us might be more right than the other at this point. With my 50%, you're just sitting in cash, but you're sitting in cash in a market that's extremely challenging in both directions at this point. I don't think that's a bad place to be. And you've already taken some profit, so not bad. Let's see. If your stock gap's down overnight, blows through your stop loss, but it's sitting at a support where it fell, do you go ahead and sell it? In a bear market, I'll just sell it. I would say like 90% of the time, maybe even more than like 95% of the time, I'll just let my stop loss, because I put stops in like good to close, and chances are it's just going to get like stopped out at the open, right? There's a couple areas, like if it's a leading stock and it's like a downgrade or a secondary offering, sometimes if I have if my account's near my account balance high, if I'm doing super well, if other positions are holding up better, not like the market we're in right now, then I'll be a little bit more flexible to see in the first 15 to 30 minutes, do buying support come in. But in a bear market where I'm off my account balance high by a little bit and everything else is not working in my direction or in my favor, stop the bleeding first. We can always buy it back at a different intraday pivot if that's your thing. But we can always buy back. In a bear market, in every market, we want to prioritize risk management, but especially in a bear market where we're just going for singles and doubles on the long side. Any reason a stock gives you to get out, I've been taking it. So IBKR still building out nicely. It is. That is building out nicely. It's a really good chart. Yeah, we'll see. I'm going to write that one down, Yeti. I know you've brought it up every single time, and it's not doing anything wrong. Still above that 8 and 21 EMAs. Nice close today, up 1.3%. I saw Robinhood announce that they're doing IRAs. Kind of thought that would have some impact, but down 2.9%, whatever. And then we got MJ here with mod. Yeah, beautiful. Bouncing at that 21 EMA, up 0.7% today. The daily bars are still a little wide, and knowing the group, truck this is equipment, right? Manufacturers, thermal management systems for automotives. Oh, so this is not just trucking. That changes it a little bit for me. Thanks for bringing this one up. I'm going to write that down as well. I have it in my world of watch list, but I thought it was just like a trucking transportation stock for some reason. Didn't read the fine print here. Now, yeah, still holding up well. We got to get some price tightening before we want to get aggressive on it if you're not already in it. But all right, couple longs to watch, and then I have a couple shorts, but keep those questions going in the comments. We'll go to 6:30 my time, so whatever that is for you, another 27 minutes. First one, ACLS. A lot of semiconductor stocks are holding up relatively well in this sell-off. ACLS is one of them. This tends to trade like ON semiconductors, where it has those gap downs, it has that whippy action. So from a personality standpoint of this stock, I don't know if I'll trade it. Also, this pivot at 80 or right around 80 just seems so obvious right now. So I'm calling this out because I want to use this as a data point, not so much I want to make money from trading this. We had a couple shakeouts. Nothing tested the 21 EMA yet, but the stock's holding up super well. Relative strength right near all-time highs. If the markets find its footing, we have a bounce day, something like that. Does this rip through 80 and not turn back? That would be one data point to where now we're thinking maybe bullish a little bit. But if this goes through 80 and then, or 81, whatever, and then reverses, like a lot of the growth stocks have been doing right near their highs, well then that's more evidence that we're still in a bear market. We still don't want to be buying flat top breakouts, anything like that. So ACLS has the relative strength. The group strength is starting to work itself up, 61 out of 197. I remember when semiconductors were 193, and it has the fundamentals there. So checking a lot of the boxes. I'm just cautious on this market, AMGN, I think this was on the breakout watch list video that I posted on Sunday. Not doing anything wrong. Came into the 21 EMA down 0.6%. Not a high beta mover, but it's a biotech stock, 24th out of 197. That group strength has the fundamentals, earnings per share rating 87, A- accumulation distribution, 94 composite. So fundamentally, technically, very, very good. Pulling into that 21 EMA on a weekly chart, looking just beautiful, right? So one that we want to keep monitoring because it's not super high beta. It's going to be a pretty tighter stop than normal, so you could probably size it up relatively large. But a couple ways I'm watching this as a potential trade is if we gap down under the 21 EMA and then take out the previous day's low, like an oops reversal, that around 181 would be my entry. That way I could just use the low of the flag here, what was that, 178.93, or the low of the day that I entered for like a 1%, 2% stop. So I could really size it up, and if it works, then it starts working with a 2% stop. The multiples of my risk are going to be very, very condensed, which kind of has been what's been working the best in this market. So AMGN, ATEN, also very impressive action lately. Came up to the all-time highs. What do you know? It broke into new highs, then immediately shook out like from 20 down to 17, around 15% there. But found support at the 21 EMA once, twice, 3 times. Tight action, and then as the Fed started to speak, as Powell started to speak, this was one that honestly I should have bought just like over the previous day's high, right through like 18.18. Beautiful action, up 3.9%. Follow through action when the Fed didn't, or when the indexes didn't have follow through action, up 1.5. Closed right near the high of the day. Then double inside candles yesterday and today. Only down 0.5% on a day where the indexes were down, what, 2? What was QQQ down? 2 point something? 2.1. So ATEN, computer software enterprises, not the strongest group, 117 out of 197. It's one yellow flag against it, but majority of my trading is price and volume, and then it goes group strength. That's kind of like the third level. Then fundamentals would be the fourth level. But the characteristics of the stock, price and volume wise, is exactly what we want to see. Really good relative strength lately. So we'll keep an eye on this one. ATEN. CRDO, this is one that I traded on the earnings pivot. I got a terrible fill and sold it like within probably like 15 seconds and actually got like 2% out of it. And then it squatted that day pretty hard. Kind of all over the place, but it's a stock that had 200% earnings per share growth, 94% sales growth, weaker group internet network, 183 out of 197, but it's an IPO that when it gets going, it can get going. We had this launch pad set up earlier in the year on July 26th, where you have the 8, the 21, the 50-day moving average, all within about 2% from each other, all below price and all curling up. That's a beautiful setup to take, and it had a really nice move. I think it was like a 45% move in just like 7 trading days. So it does have the ability to run. That's part of the reason why I tried it on the earnings pivot, just breaking over the previous day's high after opening lower. Now pulling back to the 8-day EMA, down 1%, not bad. You can see there's obvious sellers around this 1540 area, so I don't want to be buying at this obvious area. We're in a bear market. We want to be buying lower and then using that obvious pivot to sell a third of the position, half of the position, lock in some profits on the way up, or at least kind of use that as your finish, or your, I don't know. I just blanked on the analogy, but to put your stop loss to break even, to take out the risk on the trade. So CRDO, FIVE, 5 below, not going to rip your face off. It's just a discount store. Had a nice move on earnings, even though earnings were negative 33. Consolidating around 180. It did undercut 180 today, but closed right on it, 180.59. Just want to keep track of that. Not going to be putting a super large position on it, anything like that. Just one that had a gap up on earnings and is holding that relatively well given the market conditions. ISRG, Medical Systems Equipment, continues to put in higher highs, higher lows, has 1, 2, 3 unfilled gaps on the way up. Very strong. Whenever you see unfilled gaps, that's a positive sign. And trades very orderly, which we want to match our trading style and our stock selection with stocks that have the characteristics that won't stop us out on normal fluctuations. Will stop us out if the stock's breaking to the downside, but you don't want to get just shaken out randomly before a move up. And this one tends to trade more orderly than most. The 50 days under the 200 days, so that's a yellow flag. The 200 days just starting to flatten out. Mark Minervini talks about you want at least 1 month where the 200 days in an uptrend and the moving averages are in the right order. So not an A+ setup. We're not in an A+ market. So probably a stock that I'm just using as a checkpoint and more data collection from the market, but pulling back on very light volume, right around that 8-day EMA, hasn't tested the 21, something to watch. PSN, I also put this on the breakout watch list. Not doing anything too wrong. Bounced a little under the 200 or the 21 EMA. Still closed up in the range, 65th percentile, solid today, where most of the stocks and indexes were closing right near the lows. Only down 0.6% today. This is one that, if market breadth was better and we were above the bolded pivot, you could have taken this as an oops reversal, I believe, because this, hold on, did this sell off throughout the day or did it gap down? Yeah, it sold off throughout the day. With those oops reversals, you want to be gapping under the previous day's low and then taking it out to the upside and not really checking back too much versus selling off, going under the low and then reclaiming it like it did. Not as strong. But this one continues to flag out really nicely. Strong fundamentals, not the greatest group, but on a weekly chart, very, very nice, right? We break out over those IPO's highs, or the highs since IPO, and we do so cleanly, and then we also get follow through up another 4.5%, and then up basically flat and flagging out from there. But one to monitor, a little bit less volume on that one. RMBS, this is one that I took on Monday at the open, as it opened right on the 8-day EMA and kind of like where I would have bought it on the day the Fed spoke, or Powell spoke. I should stop saying Fed. And it's worked out a little bit to start, and then once we lost the bolded pivot, I just closed it out for, I think I made like $3 on the trade actually. It wasn't a loss, but still above the rising 21 EMA. I want to keep track of any stocks above a rising 21 EMA. And this is one that just made all-time highs just recently, and then 3 kind of pullback days on less than average volume. A little bit more selling today. Not super high beta stock, but something to watch. And then VVV, chemical specialty. This is more of a stock that's just tightening up really well, so we can get a lower risk entry point on it. Could probably use a couple more days to that 21 EMA to catch up, maybe even a week to improve, but chemical specialty, 83rd strongest group out of 197. And then I did want to mention SGML. I don't think it's set up at any point, but this is one where it undercut the 50-day, like got pretty extended from, when did it IPO this year? IPO'd, what was the IPO price? Around $8. So 4x your money up to $40. Quick shakeout under the 50-day. Quickly reclaimed it, and now it continuing to show relative strength. We just need to find a lower risk entry point in that name. Probably need some time to pull back given the market. But so those are the setups on the long side. Let me check the comments now, and then we'll go to the last couple short setups. But ELF, similar to above, MJ, I think you were the one that brought up ELF on a live stream, like right over here, and I was like, I can't really see a makeup company like really stretching its gains from here. It's not a very high beta stock. I don't know if it's like my criteria. And then it goes from 35 to 55. So if that was you, I think it was. You were right. I was wrong. I completely missed this entire trade. Now, a little extended for a makeup stock. Might need that 21 EMA to catch up, but I've been more wrong on the stock than I've been right. But I'd rather be wrong and the stock goes up than be wrong and the stock goes down. But good call out. NEM was rejected at the gap up at 50, then it pulled back to the EMA's thoughts. Yeah, anything below the 200-day moving average, just isn't my bread and butter for trading. So it's pulling back, like you said, pulling back on lighter than average volume. Whenever I see price under the 200-day, I just ignore the chart. Doesn't mean you can't make money from it. Doesn't mean you can't trade it. It just doesn't fit my trading criteria. Doesn't fit like what I've studied. So I avoid those setups. Doesn't mean you have to. I just don't want to give you the wrong information because charts under the 200-day moving average hasn't been what I've studied. All right. Let's see. Yeah, MANU. I heard this is in acquisition talk. So that's going to be a stock that's much more news driven. Same with NTNX, which is super disappointing because this has been holding up incredibly well. But I didn't want to put this on the watch list because same reason with MANU. I've heard there's some rumors of acquisitions. So that's elevating the relative strength of the stock now. And then if the acquisition goes through, then it's going to go through with whatever the price that they announce. But if it doesn't, and that relative strength is based on acquisition talk, well, without an acquisition, that relative strength is going to disappear, and then we're looking at a larger gap down. So I try to avoid stocks that are news-driven, unless you're trading them intraday, and I try not to trade intraday. It's one of my bad habits that New Year's resolution for next year, I will not do. So with news-driven stocks and acquisition targets, I tend to stay away from them. But if you know something I don't about the acquisition, then, I mean, you do you. Let's see. Beauty supplies are safety stocks. Yeah. I guess so. I made a decent amount of money shorting skin this year. But of course, my last short on it didn't work, so I don't know. Rejected at that 50-day. Yeah. All right, let's see. Ronaldo's contract ended, pumped, then acquisition could be on the cards. Yeah, I'm not a football or soccer guy. That's not my sport. I ran cross country in college, and now I'm getting into swimming a little bit. I love basketball. That's more the sport that I watch. This soccer thing, I understand people appreciate it, and I get excited for them. I just don't know anything about it, so I won't talk about the things that I don't know on the stream. So, okay, a couple shorts that I'm watching. Coin. It's kind of hard to see on MarketSmith, and those are typically the best shorting stocks because if they're just disappearing behind the numbers, they're extremely weak. Coin looks like it's rolling over, rejected at the 21 EMA, probably a little extended the downside now. Want kind of a check back day like Bob was talking about in the comments, where we extended the downside so quickly that more likely than not, like even if there's more juice to the downside and we get like one more day pushing down before bounce, you're really trying to time like 1 day difference versus when you're trying to enter a trade for your first time, you immediately want to be at profit because this is still a singles and doubles environment. So we want to start shorting or start buying when we break either direction out of the consolidated area, and then we can immediately start managing our risk. And with the indexes down already, if we're starting a new short position here, yes, maybe we get one more day to the downside, but if we get a check back day and now we're at break even, then what was the point of putting on that exposure? So one thing when I interviewed Leif, and if you want to learn about like how to short stocks from a US investing champion, I interviewed Leif Sereda. It's my pinned tweet, but it's also just on my YouTube channel. You could search how to short stocks, Leif Sereda. He talks about if you're not nailing the shorts like at the turn of the market, then you should probably wait for the first flush, check back, and then the roll, or he calls it the bounce and roll. So I reacted well. Like, I'm not saying I react well every single time at these market turns. I have not. I've done a pretty poor job at a couple of them. Yesterday, trading went in my favor. And that's why I was able to size up, but then immediately started taking profits and pulling the size back down. So I think if you can get a very low risk entry point, then you could take the trade, but just know where you're at in the market cycle. We're on day 1, 2, 3 on the downside. Maybe we get day 4 to the downside, but then day 5 checks you back. And if you're starting new positions, short positions at this point, you're more likely to be stopped out. But market still looks bad, but markets don't go straight down. They don't go straight up. They tend to wiggle. So same with coin. So Amazon, I covered that with my entry tactic. If it does rally back up on like below average volume than the selling volume, then I'll look to put on the 10% that I took off today. I'll just look to put it right back on to short. IPI, this is one that I keep tracking this as a potential short, but I haven't taken this trade ever. So I probably shouldn't have brought it up now, but chemicals, agriculture, 148 out of 197. Stock under all the key moving averages, the 200-day, the 50, the 21, the 8, all in the right order. Price under all of them. And we had a big selling volume day yesterday, down 5.2%, only up 0.5% today, but a little bit of relative strength there. And then Roblox, one that it looked like it was actually getting really constructive, broke over the 200-day moving average, tightened up, but then had kind of like a false breakout, squatted, and then just quickly, and with earnings, broke under the 200-day, the 50, the 21, the 8, checked back to the 50, failed, checked back to the 21, failed. Not too far extended from the 8-day EMA right now to short it, but if the market has a day where it bounces back, I expect this to kind of bounce back a little bit. So we'll see when to short it, but we're just trying to line the market cycles with our entry so we get that low risk. SBUX. Yeah, so Starbucks hit a relative strength new high. So 2 scans that I run every single day on MarketSmith, let me kind of take that away, is the relative strength new high scan. And I tend to post this a good amount of time on Twitter, but all this is current price over $7, relative strength line hitting a new high, and then the average volume for the last 50 days over 100,000 shares. So today, 96 stocks hit that relative strength new highs, and we can, I like to export it and then look at it differently, but you can just, wait, there we go. You could just scroll through it and you can see Starbucks was on that relative strength new high scan. Doing super well, especially with its competitor Dutch Bros, or one of the competitors, at least out west here. Dutch Bros is wild. I live in kind of like a college town, and people are at Dutch Bros till like 2 a.m. getting coffee. It doesn't make any sense to me, but I don't like their coffee either. But I did make a decent amount trading them earlier in the year. Now, this down 8% today, and Starbucks is just shaking them off, down 1.4%, relative strength new high. 8, 21, 50, 200-day, all in the right order, all in an uptrend. Lots of power here, and broke through 100 cleanly. Impressive. Yeah, super impressive stock. It's pulling back now a little bit. Ideally, we get like kind of a choppier pullback, allow that 21 EMA to catch up to $100, and then that could be an area where we manage our risk against with a stop like 99.40 or something like that, just under 100 and the 21 EMA. I'm in no rush to trade Starbucks because even when it gets going, it's like up 3.6%, up 1.4, up 1.6, and this looks incredible on the chart. But one day in a stock like ASC, which is oil and gas shipping stock that I traded, this was up 6% in one day. So I like what Starbucks is doing, the chart is doing. It just like trades a little bit slower. And I know someone's just going to say, well, Elf Nick, you're wrong. And I could be. But not doing anything wrong, doing a lot right, actually. I think it has some overhead supply. Yeah. We'll see. This is probably going to be a very choppy zone around like 108 to 118. And that's only 20%. So we'll see. All right. Got 5 more minutes. Any other trading questions? Any chart requests that you guys have? Anything else? I really appreciate you guys tuning in. These are always super fun to do, even when the market's not allowing us to have as much fun to the upside. But hey, we have to listen to that market feedback. I'll tell you guys, I was extremely bullish on Friday with the S&P 500 over the 200-day. With the type of action we got on Friday where we gapped down, then buying support came in, the action of the leading stocks, everything looked great on Friday. Monday rolls around, immediate feedback that things aren't working, a couple leaders starting to break key levels on above average volume. We lose the bull to pivot. And I just know in this market, like, we're already in a low probability market to make money. Once you start seeing some cracks in like the S&P 500 losing the 200-day, you can always buy back. Always buy back. We should prioritize risk management and prioritize minimizing our losses in a bear market. If we do that, we survive the bear market. The next bull market, we're going to make so much money, it's not going to matter, guys. But we got to get through the bear market with confidence and with capital. And the ways to do that is when things start to get shaky, when you start to see some signals that the market's going to roll, just going back to cash, sitting safe, and doing some more investing in yourself, in your trading education, in your systems. Because once the bull market comes around, we want to be making a lot of money. We want to have all those systems and that education ready to go. DE, this is something that I've been watching too. It's right at all-time highs, and I don't want to be buying stocks like as they break into all-time highs. So I'm trying to give this a little bit more time for the 21 EMA to catch up, but not doing anything wrong. Machinery Farm, Machine Farmery. 5th strongest group out of 197. So right group, right strength. Doesn't tend to move too fast. That's about a 10% move on the chart. But it's one that's working, so good request. All right, we'll call it there. Have a great rest of your night, guys. Make sure you leave a like on the stream, please, because other people can watch this after the stream ends, and that helps YouTube push it out to more people. Make sure you hit the subscribe button if you're not subscribed already. I do this live stream on Tuesday night. Breakout watch list on Sunday, Saturday, depending on the weekend, and other trading related videos. Hope you guys have a great rest of your night.